You are now listening to The Big Trade with Peter Pham, enlightening conversations for maximum market returns.
Marc, why don't you introduce yourself to the audience?
Hey, I'm Marc Lichtenfeld. I'm the Chief Income Strategist with the Oxford Club and the author of Get Rich with Dividends.
Excellent. Why don't you tell us a little bit about the Oxford Club and Investment U for anyone that's listening?
Sure. So the Oxford Club is a private organization of people who intend to grow and protect their wealth. And we have members all over the world, a lot of entrepreneurs, a lot of doctors, but a lot of everyday people going to 9-to-5 jobs and who are really committed to growing their wealth, to trying to protect what they have and either enjoy a better lifestyle, save for retirement, or have something to leave for the kids or grandkids. But everybody kind of shares that common goal and common mindset. And Investment U is the education arm of the Oxford Club. So it's investmentu.com is a free website that has information on a very wide range of topics, investing, mostly investing topics, but you'll also find things on taxes, pretty much, and almost anything to do with personal finance you'll find on Investment U.
That's great. So Marc, let's start off with the most important question that the listeners have right now. So previously you were a ring announcer, or you're still a ring announcer right now. On one side of the ring, you have Manny Pacquiao. On the other side of the ring, you have a gentleman named Floyd Mayweather. So on May 2nd, who's going to win that fight? And who will you be announcing as the winner?
Well, unfortunately, I won't be announcing anybody because I didn't get that job. But that would be a dream come true. I've done a lot of fights on HBO and Showtime, but that one is as big as it possibly gets. It's going to be the biggest fight of all time, at least from a revenue standpoint. As far as who wins, I mean, I have to lean towards Mayweather. He's the greatest I've ever seen in my lifetime, and I include greats like Sugar Ray Leonard and Marvin Hagler and lots of other great fighters. Mayweather is the best I've ever seen. That being said, I'm starting to read reports that he has some slight injuries to his hands, and he's had hand problems in the past. And if this fight is close, I would not be shocked to see Pacquiao get the decision for one main reason, and that would be a rematch. There is no rematch clause in either contract in the contract, meaning that very often in a fight, if the underdog wins, there's a clause in the contract saying they have to fight again. There is no clause in this contract. So if Pacquiao were to win, chances are they would do it again. So I'm leaning towards Mayweather, but I would not be shocked if Pacquiao gets a decision.
So there's no rematch clause? Is that the case? I thought there was.
No, there's no rematch clause, which is kind of unusual for a fight of this caliber.
Right,
but I guess it was so difficult to get them to agree on one fight. I would imagine getting them to agree on two would be next to impossible.
Wow. I heard the very same view from Evander Holyfield. He basically has indicated that it makes a lot of business sense, and since this is a business or investing related podcast, that if Pacquiao were to win, that would generate even more revenues for Mayweather's final fight, which would be the rematch.
Exactly, and it would be a way for him to go out. I mean, don't get me wrong. I think he would prefer, to win this fight, maybe have one more and go out undefeated. Mm-hmm. But yeah, if he did lose the fight, to come back and avenge his only loss and get another 9-figure payday would not be a bad way to end a career.
Yeah. So yeah, that was a fun little question I wanted to ask you based on your ring announcing experience. Recently also, just switching topics, is that you were at an airport in Hawaii and you were thinking about cybersecurity. What's your outlook for the sector, and what do you see in terms of the government helping some of these companies related to cybersecurity generate revenues? I just spoke to a gentleman named Shane Harris, which wrote a book called At War, and he also is very big on various different components of cybersecurity and NSA. So what are your thoughts?
Yeah, I mean, I think this is going to be, one of the most important sectors for decades going forward. I think it's absolutely critical. I mean, think about what we're afraid of these days. I don't know about you, but I'm not so afraid of Russia, dropping a nuclear warhead on New York or on my city. I'm more afraid of Russia or Chinese hackers, bringing down the electrical grid with a few keystrokes. And, that I think is really where the big threats are going to be. I mean, we could certainly have terrorist attacks, God forbid, hopefully it never happens, but we could certainly have those kinds of things in the future. But I think massive damage on a very large scale will come through cyberspace. So I do think it's an absolutely critical area. I think the government will be spending quite a bit, but I also think private business will be spending a tremendous amount. I mean, it seems almost every week you hear of a major company whose data got breached. All the major retailers, all the major banks. I mean, I don't remember the statistics, but I think it's the large banks get tens of thousands of attempts to get broken into on a daily basis, and most of them are amateurs who aren't going to be able to do very much, but they have to constantly be not just keeping their guard up, but improving, spending money on personnel and software. So I think, I wish my son was interested in coding, because I think anybody who's interested in going into this space will never be without a job. I think it's going to be absolutely huge for the next several years or several decades.
Do you have any investment ideas related to cybersecurity?
I haven't specifically looked into any of the companies. I think all the big ones. To be kind of general, I think all the big ones are going to do very well. There's plenty of pie to go around for everybody. So I'm not so worried about who's getting what market share. The Palo Alpha
networks, yeah.
All the big companies I think are going to do extremely well going forward.
One of the interesting things that the author of At War discussed about was that, for some of the bigger companies, the government revenues might come in, but they would be still very minuscule relative to the rest of the revenues of some of these companies. If Google participates with the NSA and that helps them in any shape or form, it would just be a very minute spec within the overall revenue of, say, for example, like a company like Google.
Yeah, sure. I don't disagree with that. And, kind of like I was saying with the bank example, I mean, how much money do you think JP Morgan and Goldman Sachs spend on cybersecurity on a yearly basis? But I don't know if I don't think they break that out in their 10Ks, but I would imagine it's a very large number. It is only going to continue to get larger. So you've got everything from JP Morgan to Targets to American Express. I mean, every major company. For my company too, we're constantly getting attempts on our databases, and we have to do everything in our power, and we do. We spend a lot of money and resources on making sure that doesn't happen. And we're a smaller company. You can only imagine what the giant banks and financial institutions are doing.
That's excellent. And related to another topic, which is very interesting, because right now I'm currently at Houston. You discussed about the potential recovery of the price of crude oil back to $100 a barrel by 2016. What are some of the indicators you're seeing?
Well, and the reason I went out with that forecast, and it's not that I'm an energy expert by any means, but I do feel like I know something about market behavior, and the way that energy prices crash, and it was a crash. It was very, I think, typical of a crash in a lot of ways. When you have a bear market, that's typically a slow bleed and, death by 1,000 cuts and all of that. And it's very painful and slow. But when things crash, they very often come back. We've certainly seen it, whether you're talking about individual stocks or the whole market or a commodity. Not always, but very often. And then in particular with energy, I mean, there are so many potential black swans out there. So, yes, supply is much stronger than demand right now, and that's why prices came down so low. But it wasn't a shock. When oil was at $100, we knew that there was still plenty of supply. It wasn't like all of a sudden, Chevron found twice as much oil as they ever knew, that they had in the ground. The information was out there. Just for whatever reason, the market finally acknowledged it, or however you want to put it. So there wasn't a lot of new information that led to this crash in oil prices. And then with all these potential black swans, whether it's something that happens in the Middle East or what have you, I just think that within the next 18 months, there's a very likely chance that we do see oil prices recover and make it back to 100. Now, whether they'll stay at 100 again, I don't know, but I would not be surprised at all if they rebound hard at some point, and then maybe they settle, pick a number, 60, 80. I don't know what that number is, but I would not be surprised at all, and I do expect it to hit 100 before the end of 2016.
Many people, Mark, also have very similar thoughts about this. As of early as a few weeks ago, I've even had people ask me what is the best way to get exposure if you genuinely believe in this recovery. Some people discuss about the USO ETF, for example, which I don't necessarily think would be the optimal way to get exposure on this potential recovery. What are your thoughts in instruments or tools that people or products people can invest in to capture this potential recovery?
Well, I mean, it depends on your goals. If you're a short-term trader or an intermediate-term trader, and you can kind of swing for the fences, you could certainly buy some call options on some very beaten-up companies. I wrote a book about dividends. I believe very strongly in buying quality companies that pay rising dividends. So I like some of the big, the giant oil companies. I have Chevron as an active recommendation right now. They're a company that should be able to weather the storm, with oil prices low. As they say, it's not their first rodeo. Their executives have been through boom and bust cycles before, so I'm not too worried about them surviving or even having to cut the dividend at all if prices stay low. But if they go higher, then you're buying a great company at a discount, with getting a great dividend while you're getting paid to wait it out. So that's kind of the way I like to play it. And over the long term, I think the big oil companies are going to do just fine.
What's interesting is you just mentioned to me about 18 months from now. What's interesting about that is it sounds coincidental that the presidential election would be around that same time. Yep.
Exactly, November 2016. That date, the end of 2016 was. It's not that I have crunched some numbers and said, okay, by December 2016, it was kind of a nice, convenient, target in the future when I made that prediction. That it was over a year away, but not so far away that. It was like throwing a dart and saying, okay, by 2020, because anything can happen by then. But kind of an intermediate term line. So I wasn't even considering the 2016 election. But
yeah.
You're right. That could certainly change things in a lot of different markets.
Yeah, on the previous election, I had just looking into some of the companies that were heavily involved with various different programs that Obama had implemented. For example, most of the auto companies did very well running up to the election. I almost looked at it like an event trade. Despite the fundamentals of the company, around that time, there's going to be certain companies or sectors that are going to be heavily protected as whatever the incumbent party is trying to put some halo effect over those sectors. But it'd be interesting to see oil reach that at least near $100 a barrel around that time too, because I'm sure that would be an interesting issue that would be covered by the press at the same time, and I'm sure a lot of potential presidential nominees would be asked about that and what are the programs to help in terms of oil and gasoline prices. So just a coincidence that I just noticed. So Mark, you discussed about the 10, 11, 12 system. in your book, Get Rich with Dividends. Can you tell us a little bit about that?
Sure, and then that's the foundation for my book and the Oxford Income Letter. And by foundation, I mean it's the methodology, not that it's a nonprofit. So what it is, it's a strategy for achieving either 11% yield if you are collecting income today, or if you're reinvesting dividends for averaging 12% annual returns over a 10-year period. And so basically what we're doing is we're looking for companies that have a high enough starting yield, but very importantly, that have high enough annual dividend growth. And so you kind of combine those two numbers and you make other assumptions too as far as the performance of the stock market. And, it's a mathematical formula. So if a stock, let's say, has, somebody just asked me this today about utilities, how come I don't recommend any utilities? And it's because there's not enough dividend growth. So you could have a company with a nice strong dividend yield like a Duke Energy that has over a 4% yield, but the dividend growth is very low. It's about 5%, and actually a lot of utilities have even lower dividend growth. So in order to achieve this 11% yield in 10 years or 12% average annual total return, you need a combination of high enough dividend growth and a high enough starting yield. And the other important part of this whole thing is that we are looking for companies that have a track record of raising the dividend every year. That's key. I'm not interested in companies that have cut a few times, even if they have a very high dividend, but if they have a tendency to cut, or if the dividend doesn't look stable to me, or even if they just kept it flat, I want that dividend growth, because the key part of this strategy and one of the goals is to be able to increase buying power after inflation is taken into account. And so, inflation is very low right now. People aren't talking about it too much. But at some point, inflation is going to become important and meaningful again. And then even if we just get back to the historical average, which is about just a little over 3%, which is not that high, but at 3%, it does start to eat into your buying power every year, and you compound that over 10 years, and it does become quite meaningful. So we want to have that growth that after taxes, after inflation, is increasing your buying power, especially for those people who are in retirement. You don't want to just tread water. You want to make sure you have a little bit extra, because life gets expensive.
Does the system take into account share buybacks as well, aside from just dividends?
No, it doesn't. Basically, my assumption, the assumption that I use for the stocks, is that they're going to perform as well as the market. And I'm simply using the average market return. Over the last 50 years, it's been about 7.8%. So because basically what I'm trying to do is create a portfolio of stocks, and I'm going to assume that I did not pick the greatest stocks in the world, the ones that are going to outperform the market and go gangbusters. I'm just going to pick the average stock, but that has these components of yield and dividend growth, and combined, as long as it performs along with the averages and just simply rises along with the S&P 500 according to the historical averages, you're going to get this what actually turns out to be significant outperformance. So certainly buybacks, and if you do pick great companies that have great earnings and cash flow, you could outperform the market for sure. But I'm trying to make it as simple as possible for the average investor who may not either have the skills or the desire to really dig into a company's financials and try to figure out, is this company the best company out there? It's more of, is this a quality company that has a history of dividend growth that should be able to continue to grow that dividend in the future, has a high enough starting yield, and it's really designed to make it as easy as possible for the individual investor.
What I like to do, Mark, and I don't know if this is too complicated for the readers of your letter, is sometimes even on a position like that, or even from a company that's not generating dividends, what are your thoughts about selling near dated and even like further down the line long dated calls or puts around a particular position to generate some kind of like synthetic yield to the stock position?
Yeah, I'm a big fan of that strategy, and we actually do that in a product I have called the Dividend Multiplier. I guess the one caveat I would say is I use that strategy more for short and intermediate term income. I don't do that on the longer term positions, and the positions that I have in the Oxford Income Letter and that I talk about in the book, those are really designed to hold for 10, 20, 30 years if possible, especially if you're reinvesting the dividend, because then we really want to let compounding work its magic in those later years. So by selling a covered call, you run the risk of having the stock called away from you. And yeah, you can always buy back the call if you want to hang up to the stock. But for those positions, I really kind of want to come as close as possible to setting it and forgetting it. I don't think you can ever truly forget those stocks. But, I do want to really have a long-term perspective. For the put selling, I think what could be a really effective strategy is selling some out-of-the-money puts on stocks that you do want to own for 10, 20, 30 years. And then if you get them at the price you want, and hopefully they have a great dividend, and you get an even better dividend yield than you could have today because it dropped 10%, then that's a great way of picking up some great stocks. So there might be some stocks, let's say you're following my system, but the numbers didn't quite work out. Well, you could maybe crunch the numbers and say, okay, well, if I can get the stock at a 4% yield instead of 3.8% where it is today, then it would work. So maybe I'll sell a put, and if I get the stock put to me, great. Then I have the stock that I want at the price I want, and if not, then I just collect the income and move on to the next trade.
Philosophically, because of quantitative easing, overall, the option premiums aren't that rich as they were before. So do you think it's worthwhile in the event that, a potential black swan can always happen by either selling calls or puts around some of these positions?
Yeah, I still think it's worthwhile. I mean, there's still money to be made in the right position. I mean, if you're selling a covered call, particularly on a dividend stock, I mean, you can make 4% in 4 to 6, maybe 8 weeks, depending on the stock and the volatility. And that 4% might not sound like a lot, but if you can do that in 4, 6, or 8 weeks and repeat that, and that's one of the things we try to do in Dividend Multiplier. That adds up over time. And then, if you're experienced in doing this a lot, if volatility does increase, then the numbers can get even bigger. But, you just have to be able to handle the risk of either, if you're selling the puts of being put the stock, and buying the stock if you need to, or if you're selling covered calls, you need to be able to kind of deal with the emotions of having your call, having your stock called away. And that's one thing, sometimes people don't like that. They buy a stock or they like it, and they sell the covered call, and then the stock gets called away, and they're upset. Meanwhile, if you sold it, let's say, slightly out of the money, you made a little bit of a profit, hopefully collected a dividend, and you collected some premium. So it's not the end of the world, but you just kind of have to know what the risks are, what the potential end game is, and be ready to have the options exercised before you enter those trades. But that's a long way of answering your question. But yeah, I do think it's worth it.
So Mark, we've covered cybersecurity, oil prices, your 10, 11, 12 system. What other themes or ideas right now are you covering that you could share to the listeners?
Well, totally on the other end of the spectrum of kind of conservative dividend stocks is biotech. I'm a big fan of the biotech sector. I think it's, like cybersecurity, it's going to be a sector that is going to do well for years and years to come. There's so much innovation. There's so much demand for not only the products that are out there now, but for new products. So the sector's had a heck of a run over the last couple of years. It's, some people are calling it a bubble. I don't like that word. I don't think it's accurate. But it certainly has had a nice run, and you kind of need to be aware of that, and that it could end at any time. That being said, though, I think the long-term prospects are tremendous. The big blue-chip biotech, the Amgens, the Biogens, the Gilead, are going to be tomorrow's Pfizers and Mercks and Bristol Myers, and Would not be surprised for them to become very significant dividend payers over the long term. But because they generate so much cash right now. These are big profitable companies, not the small speculative names that you often think of with biotech. But with these small speculative names, kind of the fun part about that is, those are the stocks that you hear about, tripling in 6 months and really can go gangbusters. So, if you have risk capital and you can afford to swing for the fences, to me, that's the sector you do it in, because, one positive clinical trial set of data and, you see these stocks can go 50%, they can double in a day. We've seen some crazy premiums on mergers and acquisitions. So if you can handle significant risk, and the risk is significant in these smaller names, the returns can be absolutely, I think, unlike anywhere else you'll find in the market.
Yeah, like you even said, with some of these large caps, for example, in my hedge fund, we have a position in Gilead, and it's fantastic. It's relatively higher beta than some of the more conservative positions that I have, but that high beta works somewhat in your favor. I'm a big, fan of the rule that when in high volatility environments, the best position to take is actually going long. And, there are days when your average price, for example, it will slightly sink below your average price, but there are many instances where it just quickly recovers as quantitative easing is still playing a factor the world over, and people are still positive on equities. Until that changes, then it's hard to get out of the biotech space, and their forward earning projections are still very cheap relative to the rest of the market.
Yeah, and I think that's an excellent point. I think that's kind of what's missing from this whole biotech and is in a bubble conversation. And when people are talking about the fact that it's in a bubble, or that it's overvalued, in a lot of cases they're talking about the smaller names. They're not talking about these big blue chip companies like Gilead, that are just crank out their earnings and the cash flow year after year. They've been doing this a long time. They've got lots of products. They have deep pipelines, experienced management. Like I said, I think they are very comparable to the big pharmas. Maybe 20 years ago. I think these are going to be really the big giant healthcare companies of tomorrow. Get in today at a not unreasonable valuation on the bigger names.
Well, thank you, Mark, for this conversation. Let's try to do that sometime in the not too distant future again.
Yeah, it'd be my pleasure. Thanks so much for having me.
We hope you enjoyed this mastermind session. If you'd like to contact Peter Pham or Phoenix Capital, please email info@phx-cap.com.